Interest rates are on the rise and appear likely to stay headed in that direction. Longtime analyst Maury Fertig with Relative Value Partners shares his thoughts on the subject and what it may mean to income-oriented investors.
This is a year to be cautious. Rates are going up. It's a question of how much, and there will be some money to be lost in bonds this year, but there are also good opportunities. So I would stay focused on what's happening with interest rates, what's happening with discounts, what's happening with dividend cuts, and be ready to pounce on opportunities as they develop later in the year.
Well, let's focus for a moment on the difference between short and long-term interest rates and how rising rates may affect some closed-end funds more than others.
Well, think about last year, 2017. Long rates barely budged. We stayed around 240 on the 10-year note from beginning to end of the year, yet short rates went up 75 basis points. This year it's been a little different. We've started out the year with a move between 40 and 50 basis points on the 10-year note, and we moved about 25 based on what the Fed recently has done with short rates. This shape of the curve ultimately affects investors that use leverage, whether they're borrowing on margin or specifically within closed-end funds that use short-term debt to fund longer-term bonds. And as this spread between the short and the long term compresses, there's less yield for the fund to pay out.
Looking ahead, what may be the scenario for investors in terms of what happens this year with interest rates, and how likely is it to play out?
The most likely scenario for interest rates this year is for the Fed to raise rates 2 more times, which would put short rates near 2 to 2.25%. That would also be coupled by some pressure on long rates as the Fed and as Treasury issues more bonds to finance our deficits. It's hard to see longer term interest rates coming down. In this type of scenario, I think it's going to lead to the potential for more dividend cuts in the closed-end fund arena in 2018. But that ultimately will present a nice opportunity as we get later in the year. Discounts may stay pretty wide, and then you may get some tax loss selling that compounds it. And I would be mindful of that, watch for that, and look for those kind of opportunities when the market may actually get into an oversold position. And this is particularly acute in the municipal area where most of the closed-end funds are longer dated investments, and most of those funds use leverage.